Welcome to part one of two in the video lecture for the lecture on oil. This lecture, and topic for that matter, is one of my absolute favorites. I love looking at oil. The world of oil in terms of how geographic it is, how it relates to human geography, physical geography, military geography, geopolitics, geoglobal strategies, you name it, oil is involved. Oil truly does get into the world of James Bond and business. I'm not saying this with referring to conspiracy theories or anything like that. It's a very, very fascinating realm that truly is connected to many, many facets of our everyday life. I say black gold, Texas tea, and American crack because, as this lecture is going to illustrate, Americans pretty much are addicted to oil, and at the moment we are finally starting to wean ourselves of that addiction. What you're looking at in this slide is fitting for oil because oil is connected to the largest environmental catastrophe of the 20th century. This comes from Gulf War I, when Saddam Hussein, in pulling out of Kuwait, torched the Kuwaiti oil fields. This event, of course, led to subsequent events in the region, and we're going to visit a little bit of that history in this lecture. I also want to point out not to forget your energy grid series. Don't forget about that because our smart grid is in relation to us getting off of oil. I also want to show you this. This is interesting because you have an area that is just about as lit up as a couple of major cities, and it's definitely bigger in its size than what you have over here in the form of Denver, Colorado Springs, Boulder, all these front range cities. This is also exceptional because the Great Plains are for the most part depopulating. It's an area where you have a negative population growth, except for in this area. In an area that is not known for pleasant weather, not known for pleasant winters, and it's not known for particularly pleasant summers. Yet you have a large amount of people moving here, and you have a lot of light. This is your oil and gas fields of North Dakota extending up into Canada. This is in Minot, North Dakota. This shows up the same as major cities at night. Now, I didn't really believe this until I matched the two together, so I just quickly went into ArcGIS and georeferenced that image, just quickly did that, and indeed I saw, wow, that is true, because up here, it's not until you get up in here where this is Canadian cities. I believe this is Winnipeg right here. This is associated with an area that traditionally had a very, very sparse amount of people living in it. Now, this isn't city lights. Of course, these are the oil and gas fields. It's not as if this is Chicago, but it's still very interesting how that activity and all those flares and all those lights associated with production can actually show up like that. These are some oil-related stories that gets into what I was just talking about. What we have going on in the oil field realm, and why this is a newly revised lecture as of June 26, 2013, is that I had to revise the previous lecture on oil because of all the developments that have occurred in recent years. For the first time ever, we are on the road to energy independence. This is related to our oil and gas domestic production. Now, this is, of course, not without controversy, and we'll visit that in a bit, but I encourage you to take a look at these two stories. When we look at oil, oil is very geographic, and why I like it, because when we look at the price of oil is in many ways related to global events. We take a look at this in terms of the price of oil, and you can see how going back to 1970, right before we started to have to import a significant amount of oil right before we peaked in oil production, what we'll talk about. Price of oil was around $10 a barrel. That skyrocketed to nearly $60 a barrel following the 1973 Arab oil embargo. After that, the price slowly crept down, jumped back up, slowly crept back down, and then it skyrocketed again with the Iranian Revolution. Now, it went up again when the Iran-Iraq War began. This is when the two countries are at war with one another. It spiked because people were afraid of the instability in the area dealing with the price of oil. But then they realized that, oh, it's okay. They actually increased their production to pay for the war. That led to events related to Saudi Arabia, and I'll get into this in a little bit more detail, but basically Saudi Arabia and other countries that have a lot of oil increased their production to make up for the falling cost, and that further bottomed out prices until the price of oil got really low. There was some events that went on. In fact, President George Bush went over to the area to beg for higher oil prices because the low cost of oil was actually hurting the domestic U.S. production. Now it spiked here right around the time that Iraq invaded Kuwait because people were afraid once again of instability of oil leaving. What happened there, and I'll get into more detail on this, is that Saudi Arabia invited the United States and other countries involved in the coalition to come in and get Iraq out of Kuwait. And one of the deals on that was that Saudi Arabia was going to increase their production to make up for the potential instability of Iraq cutting off their production to the world. And so in that case, the price actually went down. Following that, this is where things get really crazy. Kuwait increased their production. Everyone was increasing production. This is around the time that everyone thought that the price of oil was gonna hover around this point for a long time. Then all of a sudden you had the Asian economic crisis, and the price bottomed out. This really was a crippling blow to the oil industry. Following that recovery, the price of oil creeps back up. You have the price falling right after 9/11 because of economic weakness in the global market. And then you have a few other events as oil slowly crept up with some notable spikes up to the high prices they were in early 2008, late 2007. A lot of these spikes around in here are related to natural events such as hurricanes interrupting our domestic production. And then you had a pretty large environmental catastrophe on the Niger River Delta. You can see that here, Nigerian cutoffs. There was the wells were seized. You can see here with Hurricane Ivan. So this is pretty interesting because you can see here how spikes actually are related to the events. Very, very fascinating. Just completely fascinating stuff. So let's see what you know about oil. A barrel of oil is, if you answered 42 gallons, you are correct. It is not 55 gallons. It's not a 55-gallon drum that you think of. And this is just the rate that you have for exchange in the global marketplace when you have speculation and hedging on the price of oil. You have airlines buying up oil, certain units of oil, and of course a barrel would be 42 gallons. They're buying it ahead of time, kind of betting that the price won't go down, or they don't want it to go up, and they're seeing the trend going up. So this is where a barrel is just an exchange rate. It's a given unit. So when you refine the oil in a barrel, how much do you get? If you said 42 gallons of gas, you would say that. If you were to refine that barrel of oil into gasoline, it's not like you're diluting the oil. You get about 42 gallons of gas out of 42 gallons of oil. Now, we're going to visit this in a lot more detail, but peak oil production means mostly an area can no longer supply oil to match the demand of oil. We're going to visit that because there's a lot of talk of when oil will run out. And you don't want to look at oil production in that way. You want to look at it in terms of peak demand, peak supply. Most of the oil within a barrel of oil goes towards, if you said transportation fuel, you are correct. although it does go into these things as well, just not as much of it. We'll visit that. Petroleum. Let's talk about its use. Like I said, the most of it goes into transportation, but it also goes into heating. Not a lot of them, but there are some electric plants that use oil. However, as you might know, can tell, that would be kind of cost prohibitive. Oil is a raw material for many chemical products. So when we look at oil, it's not just used for gasoline, to make gasoline and diesel. It's used to make solvents. So a lot of cleaning solvents out there, that has petroleum in it. Fertilizers, petroleum. Pesticides, petroleum. And plastics. Plastics are huge, huge users of oil. In fact, if we jump down here, you can see that 20 million barrels of oil go into just making plastic bags every year. That's just plastic bags. That's not all the other plastic out there. And of course, 84% of that does go into fuel. So the majority, yes, it goes into fuel, but 16% of that barrel is going into other things. We take a look at oil in terms of production, consumption, and import. We see some pretty interesting stats jump out at us. We see here that Saudi Arabia is the leader in production, followed by Russia, followed by the United States. We are the third largest producer. Now, these are all pretty closely grouped together. You see China there. China is the fourth largest producer. Now, China is the fourth largest producer, but it's in a distant fourth. But if we jump over here, look at this. Ooh, they are a pretty large consumer. Now, they're half of what we're consuming. We're the #1 consumer of oil in the world, but that's climbing rapidly. And if they don't have a lot of domestic production, China's looking in other areas of the world to get their oil. And lo and behold, we are too. Now, I'm going to bring up a lot about domestic production in this lecture, but this is one of the biggest reasons why the United States is investing so heavily into domestic production and diversifying our energy economy. Let's take a look here. Oil imports, the United States is the largest oil importer in the world, followed by China, followed by Japan. Now, China is, of course, a huge user of oil, and that's going up, so that makes sense. But they also are the fourth largest producer. Japan, on the other hand, is third. Japan is an oil importer, not so much because they're a huge consumer, it's because they don't have any domestic energy. But going back into our previous lecture when we were talking about methane hydrate, that could really change the way Japan is positioned in the world, and for that matter, in Asia, in the Asian economy. We take a look at this, we can see that for the past 40 years, every president has promised to make the U.S. energy independent. Now, 57% of our oil was imported in 2010, and what's very interesting is that for the first time ever within the Obama administration, we are lowering our imports of foreign oil. In fact, our domestic oil production is higher than it's ever been, and our oil imports are going down by the week. Now, if you go to factcheck.org, what's very interesting is the administration likes to take a lot more, and of course any administration would, they like to take a lot of credit. They take more credit than they deserve, let's just say it in that regard. But what's also interesting is you still hear this rumor that the price of gasoline is so high because of the Obama administration preventing us from drilling and the like. So once again, I encourage you, whenever you hear these types of things, to go and take a look. Go to something like the Oil Drum, go to Fact Check, take a look, get your information, and make your own objectively based view on that. But it is true, we are finally going down in our oil imports. That's related to domestic production. Of course, domestic production does have its controversy. So when you freak out and post on YouTube, blah, 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 just keep in mind that this is an introductory course and an introductory lecture. Our #1 supplier of oil is If you answered Canada, you are correct. Canada is our #1 supplier of oil, and what's very interesting, a lot of that oil is coming from the tar sands, which is not really that great of a way to get oil in terms of environmental footprint. I'm going to weigh in with my opinion here, and this relates to what I've read on it, is that, I would, in a lot of ways, much rather see us producing oil domestically with hydrofracking than getting our oil from tar sands, but that's just me. Let's take a look at our U.S. oil imports. Now, if we take a look at this is from early 1980s all the way up to 2008, and what we can see here is a continually upward climb in oil imports. You can take a look at this on the U.S. Energy Information Administration. You can take a look at all sorts of different ways of graphing this out. I encourage you to do that. We take a look here though, and what we can see is that here's 1990, here's 2012. You see how we've gone down, and that trend is pretty much leveled off. This means that we are on the downward trend, and as more and more domestic production comes online in these new non-conventional wells that we have, this is going to continually go down. Now, this can also go down if we diversify our energy economy into wind, solar, and natural gas. If you went to that T. Boone Pickens website, you would have seen how big of a proponent he is to switching over a commercial trucking fleet into natural gas. That would significantly take a dent of how much crude oil we consume every day in this country. We take a look at this in terms of U.S. oil imports, and you would see that we are a mature oil province. That means that our fields, our oil fields, are in a continual decline. Now, these are conventional fields, conventionally drilled. What's going to be interesting with this is how, when we have all these non-conventional oil fields online, is how this looks. But in terms of your conventional yields and your conventional numbers, we are a mature oil province. So when we look at the future of world oil production, we have to ask ourselves the big question of how much is left. What factors weigh in? We want to look at this in terms of yield per effort, or how much effort do you have to put into getting that oil out of the ground. We want to look at this in terms of the rate of discovery. Are we still discovering oil fields at the rate we were discovering them back in the late 1800s, early 1900s? How much are we getting in our investment? Are we putting in $1 billion to only get back $2 million because we had so much overhead? And then finally, in terms of peak, is our production meeting the demand? Now this is related, of course, to demand, and you can't really say we have 500 trillion gallons of oil left in the world, and so therefore we have so many years, because you have to look at it in terms of how many people are demanding. If you had 500 trillion gallons and only 300,000 people wanted it, that would last a long, long time. But if you have a world of 8 billion people all wanting that oil, that's not going to last very long. So let's talk about Hubert's Peak. Hubert's Peak is a peak of looking at peak oil production, and that's looking at when will supply no longer meet demand. Now, M. King Hubert, he was an interesting fellow. I'll let you look into him to develop your own opinion, but let's just say he was a little odd, but he was also a very brilliant petroleum geologist. And in 1956, he came up with an equation that predicted when the United States was going to peak in its oil production, when we were going to have our peak. And he came up with the number 1972. And lo and behold, now he had a lot of luck involved in this. Of course, he also had a lot of skill. But in 1972, we indeed did peak in oil production. This led to the rise of OPEC, or oil producing exporting countries. When this happened, the Texas Railroad Commission, or our oil cartel, announced 100% allowable on oil production. That means that the flow and production of oil was no longer regulated to help regulate the price. At that point, when we peaked in oil production, we couldn't really do that anymore. And so they said, okay, you can just pump as much oil as you want. Now, it was announced quietly way in the back of the newspapers, but all the analysts in the world knew exactly what that meant. In a lot of ways, this meant that OPEC could establish embargoes on us and get away with it. So let's talk about OPEC. OPEC formed in 1961, and they really were related to what is known as the rise of the petrostate. Now, the rise of the petrostate, you read about this quite a bit in one of your readings that I have assigned for you. But these are the states that their economy and in their being is related to oil, which in a lot of ways can run you into a lot of problems. There's something called Dutch syndrome related to this. I'm not going to get into that too much, but because this is an intro lecture, but it's very interesting. The 1970s were really the age of OPEC. This is when they had a lot of clout, they had a lot of strength. They really messed with the economy of the non-OPEC world in many ways. 1973 and 1979 were both years of successful embargoes that led to massive spikes in oil prices. Now, in the 1980s, the non-OPEC nations of the world fought back against OPEC, and they did that through conservation measures, as we saw in the previous lecture, in terms of those dips, better insulated homes, better appliances, better miles per gallon on vehicles, but also by ramping up non-OPEC production. So in those non-OPEC countries, you had production going up. You had the development of the North Slope in Alaska. You had the North Sea oil fields developed. You had production going on in Norway. All these different areas of the world were opening up their production and offsetting what was going on with OPEC. Now, this kind of backfired because what ended up happening was related to this and these countries within OPEC, Iraq and Iran, increasing their production to pay for a war. You had a bottoming out of oil prices. We'll visit that in a little bit. But what I want to talk about here is related to that war between Iran and Iraq, in that Iraq and Iran fighting that war really led to Iraq wanting to increase its production just to pay for its war effort. And you also had other countries within OPEC increasing their production, and without getting into the controversy too much of this, basically Iraq moved into Kuwait's oil fields. And Saudi Arabia did not like that. Saudi Arabia had no standing military to speak of, and they had at their back door one of the most, at the time, powerful armies in the entire world. Saudi Arabia pretty much quietly went to the United States and Great Britain, were the two big ones, and said, we got a real problem here, because if Iraq invades us, they're going to have a massive amount of oil that they can control the price of, and therefore there's going to be some problems. And Great Britain and the United States knew this. Casting aside all the freedom stuff and everything, that war really did boil down to countries of the world very much worried what would happen if you had a dictator in charge of that much energy. Before we moved in, though, the United States knew that when we moved into Kuwait, that Iraq was likely going to engage in an embargo of their own, and of course they had control of Kuwaiti fields that could really fluctuate the price of oil, cause it to skyrocket. That could have implications on our own economy, if not the global economy. Saudi Arabia said, don't worry about it, we'll increase our production. That's how much oil these guys have. They have 25% of the oil in the entire OPEC nations, I think in the world. They just increased their production, and that helped balance out the price of oil. Now, what ended up happening was at the end of the war, Saddam decided, well, this is not very good, so I'll just torch the fields. The fields were torched. Of course, they were put out, and the United States emerged from that as victorious and pretty much highly looked upon. That really shaped the philosophy of what was going on through the 1990s in terms of us as a protectorate in the region, but it also helped to shape the philosophy of the second Bush administration in terms of how do we deal with that region in terms of not getting into the conspiracy of it with oil, but the philosophy was there that, geez, if we get rid of these political instabilities in the region, we can make sure that we have a decent supply of oil. And of course, there was talk of, geez, if we can do this, maybe we can actually topple OPEC. Of course, in a lot of ways, what happened in Gulf War I carried over into what happened with Gulf War II. If you were to take my military geography class, we would get into this quite a bit. I'm going to stop with that, and that ends part 1 of 2 on our lecture of oil. Our next part will talk about how scientists